Well, hello everybody, Michael Silva here. I can't keep my eyes off of this chart right over here, and I'll explain why that's important in today's stock market beef episode. We're going to get right into it today. The 11 sectors in the S&P 500, look at what's up there. In the leaderboard, we have utilities, consumer staples, and healthcare coming in third place. What is this? This is very defensive positioning in the markets. Are we seeing risk off again, or is this just a consolidation? Before we explode further to the upside, over here we see the markets in red, but not crazy. The big hit was in the Nasdaq Composite, down 1.54%, and even the VIX was down on the day. These correlations are crazy. Take a look at TLT. TLT bonds continue to rip to the upside. Going to have some warning shots over here on TLT. Now, this is where kind of the question comes in. Is this the start of a stage one in the business cycle? This is where bonds go up, and then stocks and commodities continue to go down. Now, it doesn't mean it's the greatest entry point. You don't really want to buy buy bonds when they're just bright green on the screen like this. You want to wait for pullbacks or consolidation. Now, what I find very interesting in this environment is bonds are just taking off to the upside of this channel. We have the curves even more deeply inverted than yesterday's episode when we dived into it, right? So 10-year and 2-year curve is at minus 68 basis points. The 10-year and 3-month is now minus 65 basis points. That's crazy. How crazy? Well, we haven't seen that type of crazy since 2000. Dun, dun, dun. And we all know what happened then, right? These are great indicators for future recessions. And you can see it back through the timeline all the way through. This is where you need to get your economic house in order. Does this mean the stock market's going to completely tank, crash, world's over? Maybe, but maybe not, right? We got to be prepared for any situation to take place. Now, if we're coming into this, and yes, the market is all excited when the CPI comes in lower, and you can even see that actually with an implied volatility and how people bet big when it comes into those CPI reports. But you got to pay attention because a recession is around the corner. We're seeing bad earnings. You saw Target today. It's not good, okay? So what do you need to do as an individual? Get your economic house in order, right? Pay off your consumer debts that you don't need to pay 30% interest cards. Save up some emergency funds if you haven't done so already. Build up an opportunity fund, all right? Cut unnecessary expenses, do all that stuff, take care of your household before doing anything absolutely bonkers or crazy, all right? So you can prepare yourself for the blows that come when we are actually in a full-fledged recession, if that is the case, right? Let's take a look here. I rambled on a little bit at these zone levels. The main thing that I want to point out here are 3, maybe 4 actually important assets. Okay, so first and foremost, TNX, right? We just talked about TLT. Speaking of TLT, where is it? Whoa, it's the only bright red one on the screen, people. So yeah, let's go long bonds right here. Basically what this is telling us is there's an upside of 0%. Doesn't mean it can't go higher. These are dynamic. They're always changing, but a downside of 8. All right, so pretty far downside. And then you obviously look at 10-year yield, right? That's at the lower range. There's 15% upside, 1% or to 2% downside. That's where it stands within these bands. And now if we go to the dollar is also showing, potential 1.62% downside versus 5.75% upside. So you see the green. The green is just a good visualization of where it lies within the zone. And then if we continue on from here and just look at the dollar, just take a look here. The dollar has been getting absolutely crushed, and this is why I can't take my eyes off of this chart, okay? Because if the dollar starts moving up, the repercussions of that amongst not even just like the S&P 500, but global commodities, global markets, etc., they have a very strong negative correlation to the dollar. One of the bigger correlations to this big fall to the dollar has been gold. So you can see a very strong move down in the dollar perpetuated a huge move in gold, breaking from this downsloping trend line. So as we're moving into a potential area where we're moving into contraction phase in the stage 1 of the business cycle. This is where bonds typically perform, commodities down, stocks down. Well, gold can perform well in this type of environment as well. So gold, I wouldn't be buying it right here at this specific level, but if it starts pulling back because the dollar starts bouncing, we can start looking for areas of pullbacks to potentially start to look for longs in the price of gold. Now, let's take that a step further. This is looking at a correlation chart. So it's basically saying I'm looking at gold up here, and this right here is daily ranges. So 15-day, 30-day, 90-day, 120, and then 180 of the correlation to the dollar. So the gold is up here, and then we're looking at the correlation of it right down here. And I just want to point out, look at the correlation for 15 days, right? It's minus 0.96. It's almost a perfect negative correlation, meaning that if the dollar moves down, if the dollar moves up from the low end of the zone, gold can very well get hit and brought back down. Okay, so is right now the best time to buy gold? In my opinion, no. I want to see what the dollar does. Take a look at copper. Copper is also, right, Dr. Copper. It's been on this big old pump of a run. Boom, it broke out of this wedge pattern, and boom, it moved up. We had a couple of days of pullback. Okay, and this correlation, 15-day correlation, is at minus 0.88, so a very strong negative correlation, meaning that if the dollar starts ripping or starts bouncing, it could present more downside here in copper as well. Okay, and then take a look at silver. Silver is another important one to watch. This one's been on this monster run. The correlation is a minus 0.81, so also a very strong negative correlation on that shorter time frame there too as well, meaning that if the dollar takes off, once again, these can get hit. Now, one thing that I didn't show here, but I've shown many times, is the correlation between GDX, that's a G, this is a D, and that is an X. That's a G, DDX. The correlation between silver and gold miners, the GDX, is almost a perfect correlation, a positive correlation, meaning that if silver goes down, miners can get hit too as well. So that's something to watch. S&P 500 is also another important correlation to watch. It's at minus 0.86. You can really see that well on this chart. See how when the dollar dropped off, we saw gold at that same, gold, S&P 500 start to take up to the upper edge of this kind of flagging, wedging type pattern, meaning that if this starts finding its legs or bouncing from these levels, I mean, trust me, it can still come down further, right? 105, 104, this whole area up in here. So if we get hit further, it's not over, right? Like this is just, I mean, 2022, right, for the dollar has been just putting in higher highs, higher lows, and now we're getting, we're selling off a little bit. So if this starts bouncing from lower levels, I mean, this maybe go up further, but then all of a sudden gets hit. That's always a possibility. All right. Another one to look at. Oh, and then by the way, yes, the strong correlation is obviously negative. You can see that there. FXI, so China has, and all kinds of different country ETFs have been on this monster run up because you're seeing a lot of relief from the dollar. Now, this one I'm pulling because it has a minus 0.91 negative, so it's a negative correlation of almost a 1-for-1, meaning that we've seen this rocket up. So if we're confident that, hey, the dollar will probably find its legs here soon or bounce a little bit, this kind of stuff is going to probably get hit because of the correlation that it's telling us right now, right? A strong negative correlation to the dollar. If the dollar starts bouncing, this is likely to come off. And you can see, it's kind of pulling up into this area of prior support. You can see it came up into support became resistance, and now we're back up to these levels again. So this is actually looking like a potential good opportunity to short. I did take a short position, and I covered some of it actually already today. I took it yesterday. The reason why I covered it so quickly was just to move my inventory around, but I'll look to re-add if it opens up the door for that as well. Take a look at TLT. TLT, I'm just showing this for an example. It's a minus 0.67, but if you look at the 30-day, there's pretty much no correlation to the dollar. So yes, if the dollar moves, I'm not going to pay too much attention to this correlation. Can it being that it's negative at 0.67, have a subtle impact to the downside? Yeah, but it's also at the higher end of those zones too as well. So let's take a look at the S&P 500 and where we stand overall. We're still within a down channel, right? We talked about this, lower highs. Why do I keep doing that? We have lower highs. we have lower lows, okay? And now we're coming up to the upper range up in here on this channel, saying that there could be still more room to the upside, so we can't rule that out. Me personally, if I'm building into short positions, I want to see the move up higher. I do not want to see it start to fall back down right here, because then, you know, it just takes away from the opportunities to potentially build into a little bit bigger of a position. So as it stands right now, we are in the middle of this range, meaning the range is the weekly expected move. It's an expected move. It's based off of implied volatility. It's basically 3,900 to around 4060-ish range, and we're right there. We haven't even moved on the week. Now that's important because the week still has around a $6 move in the SPY. Okay, we're looking at the SPY 15-minute time frame. We're still looking at a plus or minus $6 move, which means that, hey, volatility is still here, people. Now, a couple of things I want to call out. So this is the upper expected move for SPY, right? 408.47, and the lower edge 388.55. We pretty much tag it or go above it every single week. So there's a big door for a lot of volatility to take place right now. What I've been paying attention to was this potential topping pattern for the SPY on the 15-minute time frame. As you can see, we have little shoulders right here. We have a head, right? Left shoulders and then right shoulders. And then you can see right through here, we're building in just, you know, we have a high, a lower high, a lower high, and even another lower high. So this looks like if it starts cracking this anchored VWAP with this blue line is the anchored VWAP from the CPI report, that's going to tell me if it breaks down, it means that the average buyer since this CPI report is going to be underwater, okay? And if that's the case, that means sentiment might change at that point, right? Everyone was so bulled up when the CPI report came and all the way through. But what happens when the average person is underwater? Well, sentiment could change. Think of it as a pendulum swinging back and forth, right? Between fear and greed or whatever the case is that you want to see. Okay, but that might not happen. We don't know yet. Now, there's another thing that we can look at is this downsloping trend line. This downsloping trend line, you can see. Remember, expansion leads to contraction. And what we're seeing right now is potentially a pennant, maybe, who knows, or descending triangle, right? But if it breaks out to the upside, we can see some volatility project itself all the way up to potentially even the upper weekly expected move. We can't rule it out. We have an upsloping 5-day moving average, okay? So this is not a time to be just fully beard up or fully bulled up. It's a time to be tactical and wait and be patient for setups to occur, okay? So yes, it's a very difficult one to navigate right now. Today was a very, very choppy day back and forth. I tried my best to navigate it myself. Intraday, it was a struggle, and I ended up catching a decent trade from just a key level. But man, I had to take some cuts along the way to get there. BP-SPX chart still has a negative divergence that is building. So not only do we have a topping pattern on the 15-minute time frame, not only do we have a strong correlation, negative correlation to the dollar, and not only are we coming to the upper edge of this weekly expected move, we have a lot of signal charts telling us that we could be, you know, a little too frothy here. So it's a time to just be well aware of that, okay? It doesn't mean you can't trade bullishly to the upside, but it does mean be careful up at these levels, because if we get some sort of news event that the market doesn't like, volatility could kick in, and we could see just massive sell-side activity take place very quickly. Now, if you take a look at the Qs on the 15-minute time frame, we're right there also in the weekly, middle of the weekly expected move. You can also see we have a very similar type topping pattern where you have, you know, we'll call this the left shoulder, we'll call that the head, we call that the right shoulder. It's hard to see because I'm just kind of zoomed out a lot, but we're also holding these levels right here, and even right. So as we had support, resistance, we broke out, it's acting as support, but we have a high, a lower high, a lower high. So the bears are trying to press this back down into this chop box. And if that's the case, if it happens, I mean, we could see it, you know, target around this lower weekly expected move, which would be a pretty fast move down to just around 278, okay? And that would make sense because if you look here on the left side of the screen, let me just draw this. If you look at this as a distribution curve, right, you're looking at the volume shelf profile over here. This can very well act as a magnet. So price gets way outside of it, and then guess what? It comes right back into it. So we can't rule that out as a possibility, folks. So be careful out there. Hope you got something from this episode. Just to recap, that strong correlation to the dollar on various assets is very important, because if we can time the dollar, if we can find ways to know where the dollar is going to bounce or move from or break down from, man, it's going to help us in a lot of different trade setups. That's all I got for you, everybody. Have a wonderful night.